Deciding where to invest your retirement savings can be challenging, especially when your employer offers a range of options in a 401k plan. It's not always easy to understand the differences between these funds or determine which one will best serve your portfolio. In this guide, we'll explore a popular investment option, the S&P 500 Index Fund, and assess whether it's a wise choice for your money. Stay to the end of this video and don't forget to subscribe and give this video a thumbs up if you find it useful. Retirement investing can be worrisome, especially when faced with countless choices. For many, the primary goal is not to become investment experts, but to secure stable returns without spending endless hours researching. They seek financial products that offer both stability and growth to achieve their financial objectives. One of the most familiar investment options is the S&P 500 Index Fund. It's a reflection of the performance of the US stock market. To make an informed investment decision, it is important to understand the concept of an index, as well as explore how the S&P 500, a significant stock market indicator, operates. An index is a tool used to keep tabs on the stock market's progress, how well or poorly things are going. The S&P 500 is one such index that monitors the performance of the 500 biggest publicly traded companies. The S&P 500 index is especially significant because it represents a whopping 80% of the market's total value. This makes it the go-to gauge for assessing overall market health. Index funds take a passive approach to investing. They're a type of mutual fund that doesn't rely on someone trying to outsmart the market. Instead, they strive to mimic the index's performance. In this case, the S&P 500 index. This passive approach is why they often come with lower costs. When it comes to expenses, index funds are budget-friendly. For example, Vanguard's S&P 500 Index Fund, they only charge a tiny fee, 0.03%, which translates to $300 per year for every $1 million invested. That's a pretty cost-effective way to invest your money. S&P 500 Index Fund works in this format. When you invest in the fund, your money gets spread out across the 500 companies in the index. As these companies perform in the stock market, your investment follows suit. It's a simple yet effective way to be part of the action without trying to outguess the market. Investing in the S&P 500 Index Fund means you'll own a piece of the pie from all 500 big companies in the index. However, remember that these companies can change as the S&P 500 decides to swap some out for others. The S&P 500 is like a club with 500 members, and the guest list occasionally gets updated. Companies can join the club, and others might decide to leave. So, when you invest, you're essentially becoming a shareholder in all of these 500 large-cap stocks, and that's a lot. One of the cool things about the S&P 500 Index Fund is that it's quite diversified. This diversification is reassuring, especially when you consider that many funds heavily favor specific sectors, like tech, health, or finance. With the S&P 500 Index Fund, you get broad market diversification right off the bat. No research is needed. Sectors in the S&P 500 Index funds are as follows. Technology is the first and biggest, making up around 27% of the entire index. Technology is everywhere nowadays, so it's not surprising. Next is healthcare, which holds around 14%. This sector includes companies like United Health Group, Bristol Myers Squibb, and Amgen, all contributing to your investment journey. Third, we have consumer discretionary, making up about 10% of the index. Here, you'll find familiar names like Netflix, Disney, and Starbucks. These are companies you may interact with regularly. The fourth largest sector is communication services, including giants like Verizon, Cisco, and AT&T. They keep us connected, both online and offline, and play a significant role in our daily lives. Fifth, we have financials, featuring well-known names such as PayPal, Bank of America, and Wells Fargo. They handle money matters and investments for many individuals and businesses. Taking the sixth spot is industrials. Companies like Caterpillar, Boeing, and 3M fall under this category. They're the ones behind machinery, aircraft, and various industrial products. Consumer staples comes in seventh place. This sector includes companies like Procter & Gamble, Costco, and CVS, providing everyday essentials that we rely on. Number 8 is utilities, featuring companies like American Electric Power Company, Emerson Electric, and Eversource. They're responsible for keeping our lights on and our homes powered. Real estate takes the 9th spot within the S&P 500 index, with companies like Crown Castle International, Public Storage, and Welltower are involved in properties, buildings, and development. The 10th place goes to energy and housing companies like Marathon and Valero. They play a crucial role in the production and distribution of energy resources. Finally, we have materials. This sector produces metals, chemicals, and construction materials that contribute to various industries. You might recognize many of these significant names that make up the S&P 500 index. These companies collectively drive the performance of the index, offering you a diverse investment opportunity. The top 10 largest companies that influence the index's performance include Apple, Google, Amazon, Berkshire Hathaway, Facebook, Johnson & Johnson, Microsoft, Procter & Gamble, and Visa. Together they wield substantial influence, accounting for over a quarter of the index's trading activity and overall returns. It's important to note that not all stocks in the S&P 500 are created equal. Even though there are 500 companies in the mix, they don't carry the same weight. These 10 giant corporations dominate the scene, meaning they hold a lion's share of the index's value. One of the strengths of this index is its rigorous selection process. Before a company earns a coveted spot in the S&P 500, it undergoes a thorough examination by the US Index Committee. This vetting ensures that only financially healthy companies make the cut. Some of the criteria for S&P 500 include: first, the company must be based in the United States. Second, it should have a market capitalization of at least $8.2 billion. Market capitalization is the total value of its outstanding shares. Third, the company must trade actively in the market, ensuring high liquidity. Fourth, at least 50% of the company's outstanding shares must be publicly available for trading. This ensures a significant portion of the company is owned by the public, not just insiders. And finally, to make the cut, the company must have positive earnings in its most recent quarter. Index funds are known for their passive management style, meaning they simply track the index's performance. This hands-off approach results in very low expense ratios, making them an attractive choice for many investors. Furthermore, they offer a fair degree of diversification. However, where index funds, including the S&P 500, may fall short is in delivering higher than average returns. If you're content with earning an average rate of return, this investment can serve as a cornerstone for a well-balanced portfolio. Yet, many investors aspire to achieve returns beyond average. They seek opportunities to beat the market consistently, not just mirror it. For those seeking higher returns, the S&P 500 index may not be the vehicle of choice. You can potentially boost your returns by investing in growth funds. These specialized funds handpick the highest growth companies from the vast S&P 500. Vanguard's S&P 500 Growth Fund is a prime example. It comprises a selection of 283 growth stocks extracted from the S&P 500 index. Here's an interesting fact: more than half of this fund's holdings are in the technology sector. This sector is renowned for its potential for substantial growth, but it also carries more risk. The beauty of these growth funds lies in their ability to provide investors with a balanced approach. While you gain exposure to high-growth companies, you still retain a portion of the stability offered by other sectors within the S&P 500. In the world of investing, it's essential to keep an eye on returns, especially in the ever-changing landscape of the stock market. The S&P 500 index has its merits, offering a reasonable return during bull market periods. For instance, in a favorable year like 2019, it clocked in at just over 31%. However, when we shift our focus to growth stock funds, the picture changes dramatically. These funds, even during bullish times, can surpass the S&P 500's performance. In 2019, the best growth stock funds were delivering returns exceeding 40%. It's true that more aggressive growth funds may struggle during bear markets, but here's the twist: over the long term, they tend to outshine the rest. This decision to favor long-term potential over short-term gains can create a significant growth gap. When choosing an investment, it's crucial to avoid funds that consistently underperform the S&P 500. Instead, you'll want to explore the universe of funds that not only outperform the index, but do so with a reasonable level of risk. Your investment strategy should be as unique as you are. Your age, financial situation, retirement plans, and other factors play a pivotal role in making the best choices. For those who are just stepping into the world of investing or want a simple yet solid option, parking your money in the S&P 500 can be an excellent choice. It's a good path for those looking for stability without the complexities. Generally, if you're planning to invest over an extended period, it's advisable to opt for a slightly more aggressive approach. However, this approach must be properly diversified, holding shares in various companies from different sectors. The world of investment is a journey, and the route you choose should align with your unique goals. Remember to always do your research and be convinced before investing.